It's 7:13 on a Tuesday morning. Margaret's standing in her kitchen, phone in hand, staring at a number she's never seen before. Her 401k contribution screen shows a limit that's different. She's 62, and for the first time in her career, the IRS is letting her put away more money than her 58-year-old coworker. A lot more. Today we're talking about the super catch-up contribution, a provision hiding in plain sight that could add tens of thousands to your retirement. Let's break it down. Here's a question. What if I told you there's a 4-year window, just 4 years, where you can legally stuff an extra $11,000 into your 401k every single year? And that window only opens when you hit 60, slams shut at 64. Most people have no idea it even exists. By the end of this episode, you'll know exactly who qualifies, how much you can contribute, and the Roth requirement that could trip up high earners. Let's rewind to December 2022. Congress passes SURC Act 2.0, a massive piece of retirement legislation. Buried in that bill? Something called the Enhanced Catch-up Provision. For decades, the rules were simple. Turn 50, get to contribute a bit extra to your retirement accounts. The catch-up contribution. Standard across the board. But here's what changed. SECR 2.0 created a special tier for workers aged 60 to 63, not 50 plus, not 64. That specific 4-year window. The logic? These are your final stretch years. Your peak earning years often. Your last chance to turbocharge that nest egg before you start drawing from it. And unlike most tax provisions that phase in slowly, this one went live immediately in January 2025. Most employers weren't ready. Many still aren't. So let's talk numbers. For 2026, the standard 401k contribution limit is $24,500. That's the baseline everyone gets. If you're 50 or older, you can add an additional $8,000. That's the standard catch-up. Brings your total to $32,500. But if you're 60 to 63, your catch-up limit jumps to $11,250. That's an extra $3,250 per year. Do the math. 24,500 base plus $11,250 catch-up. Your maximum annual 401k contribution? $35,750. Compare that to someone age 59 making the same salary. They max out at $32,500. You're putting in $30,250 more every single year. Over your 4-year eligibility window, 60, 61, 62, 63, that's an extra $13,000 in contributions alone. Before any growth. And here's what the simple math misses: compound growth. $1 invested at 61 has 5 years to grow before you hit 66. Assume a conservative 5% annual return. That $13,000 in extra contributions becomes roughly $17,000 by the time you're drawing down. 7% return? You're looking at closer to $19,000. That's the magic of having those final years to let your money work before retirement. Now, here's where it gets complicated. There's a wrinkle in this provision that high earners need to understand, and it kicked in January 2026. Starting this year, if you earned over $150,000 in FICA wages in 2025, all of your catch-up contributions must go into a Roth account. Not pre-tax, Roth. That means you're contributing after-tax dollars. No immediate tax deduction on those catch-up amounts. For some, this feels like a penalty. You're in your peak earning years, probably your highest tax bracket, and now they're forcing you into after-tax contributions? But let's think about this differently. Your situation is specific to you, your tax bracket today versus retirement, your other income sources. There's another way to frame it. Roth contributions grow tax-free. Tax-free in, tax-free out. Every dollar of growth, every dividend reinvested. None of it gets touched by the IRS in retirement. And consider this. Tax rates change. If rates rise in the next decade, and plenty of economists predict they might, locking in today's rates could look pretty smart in hindsight. So what should you actually do with this information? If you're 60 to 63, your first move might be talking to HR. Ask one simple question. Does our 401k plan offer the enhanced super catch-up contribution for ages 60 to 63? Not all plans do. Some employers haven't updated their systems yet. According to the Charles Schwab Retirement Planning Guidance, for people aged 60 to 63, there is an enhanced 11,250 super catch-up, provided your plan offers this SEC Your 2.0 provision. If your plan doesn't offer it yet, you've got options. You can advocate for the change. Talk to your benefits manager. Sometimes the squeaky wheel gets the contribution limit. You may also want to consider running the numbers on your own situation. Can you actually afford to max out at $35,750? What would that look like monthly? At $35,750 per year, you'd need to set aside just under $3,000 every month. For a lot of people in their 60s, that's doable. For others, it's a stretch. Here's one framework that might help. If you can't hit the full limit, prioritize reaching at least the employer match first, then work toward catching up from there. Speaking of employer match, those contributions count toward a separate limit. Combined employee and employer contributions can reach $72,000 for 2026. That $72,000 includes everything: your pre-tax contributions, Roth contributions, employer match, profit sharing, the whole package. But here's the reality check. Most people aren't anywhere close to those numbers. According to a Schwab survey from last year, more than half of 401k participants say inflation is their primary obstacle. Inflation's running at 2.4%. Medicare Part B premiums are jumping 9.7% in 2026 from $185 to $202.90 per month. Every dollar you save today is a dollar that isn't getting eroded by those rising costs. That's the real reason this super catch-up provision matters. Now, let's talk about that Roth requirement again. If you earned over $150 last year and you're in this age bracket, you've got a decision to make. Consider consulting a tax professional. Some high earners are frustrated by this rule. They wanted the pre-tax deduction. They're in a high bracket now, maybe a lower one in retirement. The math doesn't always favor Roth. But others see it differently. If you believe tax rates will rise, Social Security solvency issues, national debt, whatever your view, locking in current rates has real value. There's also the tax diversification argument. Having both pre-tax and Roth buckets in retirement gives you flexibility, the ability to manage your tax bracket year by year. Want a higher income year? Draw from pre-tax. Want to stay under a Medicare premium surcharge threshold? Pull from Roth. That flexibility is worth something. One approach worth considering: if you're close to that 150 threshold, look at whether you can reduce your FICA wages. Timing bonuses, deferring compensation, maximizing HSA contributions first. But honestly, for most people in this bracket, the extra paperwork isn't worth the gymnastics. Just take the Roth contribution and focus on the bigger picture. Remember, once you hit 64, the super catch-up window closes. You drop back to the standard $8,000 catch-up limit, same as everyone 50 plus. So if you're 60 right now, this is your moment. You've got 4 full years. If you're 63, you've got 1 year left to take advantage. Let's put real numbers to this. Say you're 60 and you max out your 401k for all 4 eligible years. That's $143,000 in contributions alone. Compare that to someone who doesn't know about the super catch-up, maxing out at the standard $32,500 for those same years. They contribute $130,000. That's $13,000 extra in contributions. At 5% annual growth over 5 years, that extra $13,000 becomes $17,000. 7% growth, nearly $19,000. And that's assuming you stop contributing at 64. Keep working and contributing even at the standard limits, and that gap keeps compounding. Here's the honest version. Nobody, not the IRS, not Wall Street, not your favorite finance podcast, knows exactly what tax rates or market returns will look like in 10 years. What we can do is look at what the historical patterns suggest with the full understanding that past performance does not, and this is important, does not guarantee future results. If you found this breakdown useful, consider subscribing. We put out episodes like this regularly, diving into the numbers behind major financial decisions. So let's recap what you might want to consider. First, check if you're in the magic window. 60 to 63. If you're 59 or 64, this specific provision doesn't apply to you. Second, contact your HR or benefits administrator. Ask if your plan has adopted the super catch-up provision. Not all have, but you won't know until you ask. Third, run your personal numbers. Can you increase your contribution rate? What's the monthly impact? How does it affect your take-home pay? Fourth, consider the Roth factor. If you're a high earner, those catch-up contributions must go Roth. Talk to your tax advisor about whether that changes your strategy. And fifth, remember the window closes. The super catch-up is temporary by design. It's a 4-year gift for those specific ages. Use it or lose it. We started this episode with Margaret, staring at her phone in the kitchen. That different number on her 401k screen, now she knows what it means. It's not a glitch, it's not an error, it's an opportunity, one that Congress specifically created for people exactly her age. The super catch-up contribution, $11,250 extra per year, 4 years, 60 to 63. Now you know it exists. The question now is, what are you going to do about it? This is Money Moves Daily. We'll see you next time. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. Remember, this content is for informational purposes only and is not financial advice.